2.
Welcome to 2017, and if you're like me, I like to set goals, kind of informal goals at the beginning of the year, but a lot of people think I'm going to reassess what I'm doing with my investments for 2017. Now, I'm going to give you a New Year's resolution that you might want to stay away from. Now, let's just talk in general about the stock market. If we go back through history, you have different areas of the market with different expected returns and different amounts of risk. Large companies, small companies, value, and so on and so forth. And you see the market has delivered really respectable returns throughout history. If we look at a more recent period in time, let's take this and step back and just go back a few years and look at what has really done well recently. You'll see that large U.S. stocks, definitely. And that's a very popular area of the market for American investors. All companies that they recognize. The other area that's done really well is real estate. And if we look at real estate, we see that from 2010 till now, great returns, and a lot of people have done well with their real estate investments. Now, one of the things we got to think about is, well, that's done really well lately. Is it something I want to just get more money into and start focusing more of my attention on? Well, let's take a look back and go back to the 1970s. And to put this in perspective, you see where real estate and large U.S. stocks are sitting on this chart, and it's not nearly as great as the previous chart looked. Now, real estate still done respectively well, but if you think about it, when I'm owning companies, I already have a lot of exposure to real estate because those companies own real estate. And think about it, if you own a home, you already have a lot of exposure as well. It may not be such a great idea to go and start focusing your efforts on something that did well in the recent past, as you can see. So let's take a look at November. We had a big election, kind of a surprising election, really. And one of the things that happened was that interest rates started to inch up. So if we just look at the month of November only, we see that actually real estate is at the bottom of the barrel. So a lot of people go, well, I want more money in real estate. I want more of that thing that just did well. You might think twice, because as interest rates go up, the cost for borrowing, which is how a lot of people buy real estate, goes up. And when the cost for borrowing goes up, it makes it harder for people to afford properties, and they have to lower the price that they're willing to pay for those properties. So we can see right here, number one, past performance is no guarantee of future performance. Don't chase returns. When it comes to investing, you don't want to look at what just did well and say, man, I want to put more of my money there because it rewarded me in the past. Bad way of investing. Number two, investing isn't horse racing. Now, if you think about horse races, you might have a certain horse that wins race after race because it's based on their speed, it's based on their strength, and maybe the jockey. But investing markets, one time period, this area of the market will do well. The next time period will be a totally different area, and there's no way to predict it. Bad way of investing when trying to look at past performance. And number three, remember diversification is just basically saying, I'm always going to own something that doesn't do well. That's why we diversify. In the late 90s, when I was investing and trying to figure out what to do with my money, one of the things I knew that was a good diversifier were international small value stocks. You know what their 5-year performance was to the end of the decade? 5 years, 0% return. Most people would say, I definitely don't want that. But over the next 10 years, that area of the market about quadrupled in value. Did I know that was going to happen? Had no way of knowing. But I knew it was a diversifier. So remember to diversify broadly. Don't put all your eggs in one basket. And make sure that as an investor, you don't chase yesterday's winners. We'll catch you next time. I hope you have a great 2017.